Hey everybody, it's Chris Miles here, your anti-financial advisor. Hey, I want to show something because many times people ask me, especially with those that are in the infinite banking world, saying, well, hey, if I have more cash value in the first year or the first years, that should be better, right? Like, that those 90-10 policies with Mass Mutual, for example, which is a company I work with, or, versus other companies where it might be less. And so the assumption is the more cash you have in year one, the better it would be because the lower the cost, the better, right? That's not exactly accurate because insurance companies can spread out the costs however they want. So I want to show you an example here comparing Mass Mutual policy with Penn Mutual policy, which are both companies that I tend to favor the most out of the different infinite banking policies that I use. So let me just give you an example of how it looks because it is deceiving when you really look at it this way. So this first one, this is the Mass Mutual policy. This is actually a person that's 58 years old. They're putting in $40,000 a year. So now with an older person, these numbers are actually closer than usual. So this is why I'm using this, because if you're younger than you're 50, like if you're mid 50s or younger, this tends to happen faster, right? So anyways, you'll see here, if you put in $40,000, that first year's cash value right there is about 37,600. So this is even better than 90%, right? This is more than 90%. This is getting closer to roughly about like 93% of your money going in the first year. Now, granted, you can't touch the money in the first year, so it's not really accessible, but it's there, right? Now, year two, 77,000, right? That's great. Awesome. 118. Finally, year four, you actually break even on your costs in this scenario where you get $161,000. And then, of course, it keeps going from there. Now, I'm just going through the 10th year because, this guy doesn't plan to go beyond the 10th year, right? But at the end, he's going to have $370,000, right? Which is good. That's really decent, Now, granted, Mass Mutual's got a higher dividend that they're quoting right now. They're showing 6% because that's the current dividend rate. Now, let me show you Penn Mutual, which is only showing a 5.75% dividend. So you'd think, one, if there's less cash value in the beginning, and two, if they have a lower dividend, they should lose, right? Well, here's the trick. This is why you got to learn about insurance companies, that not all things are equal. So you'll see here, definitely not 37,000 year one. It's only 30,000, right? So here we'll see $30,000 in year one. Year two, you're at 64,000. Now remember, Mass Mutual was at 77,000 by that point. Even here, you're at almost 149,000 year four. If you remember the Mass Mutual policy, it showed like 161,000 by that point. So there's like $13,000 more. You think there's no way it's going to catch up. But watch this, right? Year five, of course, it's almost breaking even. It's not until year 60 you break even. Now look at this, year seven, 297,000. Now, if I go here to year seven, where that's also happened as well, you're at 298,000. So look, there's only about a $1,000 difference all of a sudden. Why? Well, here's the big thing is that what's going on right now is that Penn Mutual is drastically lowering their insurance costs. They charge more upfront, but then back them off big time. But see, with Mass Mutual, what they're doing is they have very low costs upfront, but they're spreading those costs out longer. So yeah, it has earlier cash value, which is awesome, right? But it doesn't last forever. And especially where I get real estate investor clients, they'll say, yeah, but Chris, don't I want more? It's like, yes, absolutely. I want more just like you do. But understand that you're probably not investing just for 3 or 5 or 6, 7 years, right? You're probably going to have money you're using longer than that, So when we're dealing with this, it's a different scenario. So notice by year 10, remember the Mass Mutuals was showing 370,000. Look at this, Penn Mutual, same thing, $383,000. So almost 384,000. So now there's over a $13,000 discrepancy now in favor of Penn Mutual. Now you'll see this one keeps going. They'll even put almost $6,000. You're at 389. Well, this one's you're putting no money in, and you're still at 403,000. So even though you're not putting any money in, 492 after 15 years, this one's at 473. So you're putting money in to this policy, but the problem is that it's still not catching up. This is what you got to look out for. It's so easy to say, well, look, if I got more money year one, 30,000 versus, or 37,000 versus 30,000, that should be it, right? This is it. Be careful because that doesn't mean everything. Now, I'm a total fan of having more money now, like, in the earlier years and having accessible and later too. But I do warn my clients, even though I can do either of these policies, I do warn them and say, listen, unless you're only going to be having a policy for a couple of years, you might want to look out, because here's what it's really doing. So I thought that might be informational and beneficial, because this is a policy that all the time people say, what about that 90-10 policy? Should we do that? The answer is maybe, but in many cases, it may not be the best option if you want your money working harder for you, for it to be more efficient, less costs overall. You got to be careful. So anyways, I don't want you guys to get duped. I want you to be careful. Obviously, if you have questions, you can shoot me an email, chris@moneyripples.com. Hey guys, I hope you're making a wonderful day. We'll see you.